Ladies and gentlemen, we are living through something unprecedented, and I do thank you for tuning into this broadcast. We're going to look at how the impact of the Federal Reserve statement today affected the precious metals, what the Fed is planning, and how things are looking for the metals over the intermediate term. My name is Christopher Aaron, and thank you for tuning in. Let's get right into it. There was a Federal Reserve meeting here today in the United States. The Fed is the central bank of the United States. It meets once per 6 weeks for these policy meetings. And the big news to come out of the meeting today was not an interest rate hike of any sort, although they did hint that there would be one more interest rate hike later this year. The big news for this meeting was that the Fed is going to start a portfolio drawdown in October. Now, they first discussed this in June. We saw a sell-off in the price of gold and silver when they discussed this in June. And here we are in September, and they are confirming the intentions to begin drawing down their portfolio. And I really wanted to show you exactly what's happening here on the charts and what this exactly means, because there's a whole lot of euphemism and a whole lot of doublespeak and using words to try to confuse what's actually happening here in the Federal Reserve. And I really wanted to put this in the most clear terms possible. So what does this mean? Portfolio drawdown. We have to go back and look at the Fed balance sheet. So they are talking about drawing down, in other words, selling off their balance sheet. So we have to bring up the chart here. This is courtesy of the Wall Street Journal. We are looking at the Federal Reserve balance sheet going back from 2004 through the present. So there's a whole lot of jargon here, but I want to put this in as simple terms as possible, which is that the Fed balance sheet from its founding in 1913 through 2008 was $1 trillion. So it took them 95 years to get to $1 trillion. And what does this mean, $1 trillion on their balance sheet? What is a Fed balance sheet? Where do they get the money to purchase all of these assets? All of the assets that they purchased up through 2008, where did they get the money for this? Can you guess? Of course, where does the Fed get their money for anything? Anything that the Fed does, they print the money out of thin air, or the electronic equivalent. They debase the currency, which is no longer backed by anything. They print it. And then they go out into the market and they buy the assets that they want. Now, if you or I did this, we would be thrown in jail. But the Fed has a special power, which has been given to it by the United States Congress under the Aldrich Act in the early 1900s, and they are allowed to do this. We've given them control of the currency. Now, this would be fine if it was a truly impartial institution. Of course, we know that the Fed is owned by its member banks. Who are its member banks? The large multinational banks around the world. We can all name the names: Bank of America, Citibank, Goldman Sachs, Deutsche Bank, etc., etc. So it took this consortium of banks, the Federal Reserve, almost 100 years to print $1 trillion worth of money to get its balance sheet this high. And in the last 9 years, it has printed an additional $3.2 trillion. So a staggering increase shown here on this graph, a staggering increase in the number of dollars that have been created, and therefore the debasement to the currency. A staggering increase compared to the previous 95 years of Fed history. So we're seeing that here, and the acronyms given, the names given for these various forms of printing the currency, they're all given different names. We remember, if you've been following this since the mid-2000s, so QE1, and you had TARP and TALF and all these other, bailout programs here, QE2, Operation Twist, QE3, blah, blah, blah. This is all euphemism for printing money, and we can see the results right here. So unprecedented printing of U.S. dollars, debasement of U.S. dollars through the present, and the Fed is now talking about reducing the size of the balance sheet. So if they printed dollars to expand the balance sheet, what does it mean if they're going to draw down the balance sheet? This means, theoretically, when they are selling these assets, that they are extinguishing dollars in the money supply. They are lowering the money supply when they sell off their assets. So if it's inflationary when they are printing money to buy assets, it makes sense that it is disinflationary when they sell assets and thus reduce their balance sheet. So over the short run, this was interpreted by the gold market. It was basically a confirmation that the Fed will be reducing its balance sheet. It looks like they are going to carry through with their word. It looks like they are going to indeed begin this program. They've talked about starting in October, starting a $10 billion reduction per month. And we will see. We will see if they actually go through with it and to what extent. But over the short run, the bottom line for us as investors, we can doubt that the Fed will actually go through with this. I actually personally have intense doubts. I actually would put the odds that they actually fully reduce their balance sheet back down to pre-credit crisis levels, back down to that $1 trillion level. I put that as basically zero. I say there's no chance that that is going to happen. But over the short run, the market is believing them to some extent. And so therefore gold, which tends to thrive in an inflationary environment, gold was sold off. Of course, we know gold has other scenarios in which it can thrive, tensions, international tensions, such as what we have seen with North Korea. Tensions are dying down with North Korea, at least over the short run. So some of those sellers choosing the occasion to divest of their gold holdings here in the futures market. Let's switch over and look at silver. Similar action here happening in silver. The one interesting point to notice is where gold closed below the low from Monday. Silver actually closed right above the lows from Monday. So some slight but noticeable outperformance in silver. And if you watch the precious metals on a regular basis, you will know that when you start to see slight outperformance in silver, it's telling you that perhaps the weakness that's coming here, or that may be coming over the next couple of days, is not going to be that severe. When silver is holding up relatively better, even on an intraday basis, that is generally a good sign for the precious metals as the gold to silver ratio is lowering. So we will get rid of this and let us turn to the 1-year chart. Now, the point of this channel, what separates the type of analysis that I do from what I believe exists in a lot of the precious metals community out there, is I really like to stay focused on the charts and the interpretation of the charts. So this chart that we were looking at here, we're now looking at the 2-year time frame, massive triangle that broke out to the upside, made a functional test of the 2016 highs here, got to within about $16 of the 2016 highs. We've now come back down. Now the closing price for this chart is not accurate. Why? Because stockcharts.com, although I like them from a general charting, I do not like the fact that they choose the futures contract closing price for the daily close. The futures market, of course, closing at 1:30 p.m. Eastern time, which was before the Fed meeting. So this bar does not include the fact that gold in the after hours market has fallen all the way slightly below 1300. So we are really right down here where this green arrow is on the chart. Just keep that in mind. So where are we? This is where the charts, I think, are really helpful. So there was damage done to the gold market, but one of the basic principles of technical analysis that we are looking at here is that when you have a very clear level, this 1295 to 1300 level right here, this was hit twice, including a false breakout here, twice representing the lower region of the Trump reversal resistance. This was hit twice and broken decisively. We are now coming back down into this region. All things considered, I would expect support to be found now in the gold market. So it is quite possible that the low is already in. It's quite possible that it makes a nominal new low tomorrow, perhaps down to 1290 or 1292. This is the highest probability scenario based on the charts. Based on the breakout that we've seen here, coming back into this region, the highest probability scenario is that we then power higher and gold at some point in the later part of this year or early next year breaks through the 2016 high. And then it's off to the races in my book. Now, you don't want to be chasing gold higher after it does that. I think an important point here is to be reading the charts and looking at a risk to reward basis. We've had this massive breakout and you're coming back into the retest zone here. I'm never saying to put 100% of your capital into any one thing, but this is one of the better setups that I have seen coming back into this retest zone. This would be where you want to start buying before the 2016 highs are broken. Now, if I am wrong here, and I admit the fact that every form of analysis can be wrong from time to time, but we are trying to stack the odds in our favor. It's certainly better than just using the fundamental-based analysis. I won't name any names, but you guys know a lot of the regular commentators going back from 2011 who were just saying, you know, gold's going higher, gold's going higher, gold's going higher, and what happened? It kept going lower and lower and lower, right? So fundamental-based analysis in my book is completely bogus. You have to pay attention to what are the traders, what is the market actually doing. So what's actually happening is we're coming back into a very important support level. And on a balance of probabilities, I say this holds. And if I'm wrong, the next level of support that I'm going to be looking to hold is all the way back down here, this broken trend line. Okay, the broken long-term trend line. This is sort of a worst-case scenario for the bull case. So that comes a bit lower in the 1240 to 1250 region right now. Highest probability that gold is going to hold here presently. This would be the worst-case scenario. Now, if gold breaks down further below the 1240, 1250 region, if it were to fail here, you have a clear violation of the breakout. In that case, the entire bull market thesis has to be sidelined, likely for another couple of years. I do not see that happening. I think this was such an important breakout that I do not see it failing at this point. That's my best assessment of what the charts are telling me, trying to stack the odds in our favor. Okay, so I am a technical-based analyst. Plenty of fundamental-based analysts out there, but just go back and look at their track record from, the last 5 years or so. And I will say, I have found in my own work that a sharp but an accurate reading here of the charts stacks the odds in my favor a lot more than just going based off some sort of perceived fundamentals. I think we're coming into an important low here in the gold market, and you don't want to be chasing this market higher after it breaks those 2016 highs. This is the period to be accumulating before that happens. I'm saying that based on the charts. I do offer a premium weekly research service that comes out at least once a week with flash updates in between. We do members-only videos like this. The one that's coming up this weekend is going to be exactly like this, but a lot longer. It's going to cover every single thing that I'm seeing in the precious metals at this time, including the long-term charts, including silver, the gold mining sector, the individual miners that we follow, and looking at the US dollar and the broad commodities as well. It's basically everything that I need to study myself. There's no way that I could be an investor in these markets without studying the range of charts, and I just published them. That's it. So you can find more about that on the website. If you are new to the precious metals, or if you're thinking about changing your holdings, you're thinking about switching over from physical to the miners, or you're thinking about making some purchases in metals for the first time, and you would like to have an individual consultation with someone who does not sell the precious metals, and depending on your situation, I work with people and I tell them, look, you are overinvested, or look, I think you should sell some of this individual miner because you're overexposed, and I think you should take a more conservative approach. I do work with individuals on a one-on-one basis by phone, by Skype, and by email. You can find more about that on the website too. So the Fed here, in summary, is coming out and they're saying that they are going to start reducing their balance sheet. I put the probabilities that they are going to do so over the next several years in any meaningful way at slim to none. But the market right now is taking them at their word. And if anything, I would say we're living through one of these crazy periods of time where, you know, we talk about bubbles a lot, and there's a debate, you know, is there a bubble in the cryptocurrency market? Maybe, maybe not. Is there a bubble in the real estate market? Maybe, maybe not. I actually think the biggest bubble that we have in our society today is a bubble in faith in the institution of central banking. And if anything, the last several years has just furthered that, because to the average person, the average investor, all they know is that the Fed did some crazy things in 2008, 2009. They did what they had to do, but look, it worked, right? The world is still running. Everything is kind of humming along. The stock market is at an all-time high. The dollar is fairly powerful. It worked. I think in the broad scheme of history, that is going to be a temporary scenario. But it is the state of affairs right now, and we do have to pay attention to what the rest of the market is saying. If we choose to ignore the rest of the market, it's just like ignoring the tide coming in, or a train coming into the station, even though we think it's supposed to arrive at a different time. We have to pay attention to what is, not only what do we think should be. So I do thank you for tuning in. The next update will be a week from tonight. Thank you. Have a good night.